If inflation goes from 3% to 6%, that's better for gold than inflation staying where it is and the Fed cutting. Because what's important for gold is real interest rates. The nominal interest rates at the end of the day don't matter. Even if the Fed raises interest rates to 10%, if inflation is 30%, do 10% inflation interest rates matter? No, you're negative 20%. You would want to buy gold even more aggressively if we had 10% interest rates and 30% inflation. So it's the real rate that is important. And the traders still don't get this. Now, eventually, if the war goes on long enough, this is going to stop. At some point, gold is going to start to go up when the escalation goes up. But we haven't reached that point yet. But I think the pullback, if you look at the pullback to 4,100, that's about 40% retracement of the entire rally. If you measure the rally from the breakout at 2,000, right? That was really where we broke out. So it went from 2,000 to 5,600. A 40% retracement is about 4,100. Now, as we're talking now, and I'm going to get to why this happened, but gold's back above 4,500. So it's already bounced more than 10% from Monday morning's low. But that 40% retracement is exactly the decline that we got. The bull market in gold from 2001 to 2008, or that bull market where gold went from under 300 to 1,000, the 40% retracement there was about what we did in between August of 08 and like November of 08. During those 4 months, gold pulled back about 35%, which was a little bit bigger than the pullback that we've had so far, although this pullback was quicker. Gold's decline since we started the Iran war, it was a much faster decline than the one that was triggered by the 2008 financial crisis. That's how sharp the decline was. In fact, last week was the worst week gold's had since 1983. So way before the '08 financial crisis.
In 2008, the panic-driven liquidation set the stage for an explosive multi-year rally. If gold follows that exact same mathematical trajectory from today's bottom, the absolute minimum price target will shock retail investors who sold their positions in fear.
But if you look at the magnitude of the decline relative to the entire bull market, what we've already had in 3 weeks is about the same as what we had in 4 months of the financial crisis. But what's significant is after gold bottomed in November of 2008. Now, the stock market didn't bottom until like January or February or March, I forget, of 09. The stock market fell another 23% after gold bottomed. But after gold bottomed, within 3 years, it tripled. Gold went to 1,900. So if gold does the same thing again, has a 40% retracement, and then triples, gold's over 11,000. Now, I actually think gold's going to go a lot higher than that. I think the fundamentals are a lot better now than they were in 2011. So if gold could triple after a 40% retracement back then, it can certainly do at least that, if not more now, which is why everybody should take advantage of this decline and buy silver. In fact, silver went all the way down below 63. Remember, silver got to 121 or something like that. So almost about a 50% decline in silver from its peak, not a retracement of the rally, but a complete 50% decline. Silver right now is about 71 and a half. So about $8 higher than it was Monday morning. So better than, again, 10% bounce off of those lows. But again, don't forget, buy some gold and silver before we rush up to new highs, before the markets realize that win or lose this war, gold's going higher. And the longer it continues, the more bullish it is, despite how the markets are trading. And these gold stocks, they are the best buys. They came down dramatically as a result of this. All of this is noise. None of this is going to matter to the massive profits these gold mining companies are going to be earning for years and years to come. Even though gold prices have come down, they're still $4,500 an ounce. Yes, silver's come down. It's $70. These are great prices, and these mining companies are going to make a fortune, and they're going to make even more money because the market is going to move to new highs, and I think before the end of the year. So this is just a very small bump in a long road. So Trump set off this, big move in the markets based on this ultimatum. Then, out of the blue, on Monday morning, before U.S. stock markets open, he posts on Truth Social, hey, great news. We're making a lot of progress in our talks. I think we're going to have a 5-day pause on this bombing of the power plants. We're having really productive negotiations. I think we got a deal here. This is great news. I forget exactly what it was, but it was a complete opposite of the tweet on Saturday morning. And of course, it contradicted everything Trump had been saying in the prior week about we're not going to negotiate. There's nobody to negotiate with. Iran wants to negotiate. Iran wants to make a deal. I don't want to make a deal. Screw them. Unconditional surrender. We're going to bomb you into oblivion. You just got to give up, right? No deal. That's what he was saying before. Now, of course, everybody says, well, that's how he negotiates, right? He's got to say all this stuff. So again, if that's the case, you can't believe what he's saying. Maybe he has to lie in order to get what he wants, but why are we taking it seriously? If we know that that's his style. But so now this comes out and it's a huge reversal. Dow goes up like 1,000 points, 2,000 points. I mean, it gave back some of the, but it was a huge rally. Oil dropped like $10, right? Oil was way up. It went way down. Gold reversed, didn't really go positive, but gold was down like $250 before the post, and it recovered those losses. Silver, which was down like $4, went positive a couple of bucks. So everything reversed. And I have a hard time believing that somebody didn't know that post was coming and didn't make some bets, either in the S&P 500 futures or oil futures or currency futures. And in fact, now I'm hearing all these reports about mysterious large trades that were placed in the S&P, in oil, 5 minutes before that post. Very, very large wagers of a size that nobody would make just on a random hunch. And why would you even have that random hunch? Who the hell would know? The only way somebody would come in with that size at that particular time is if they knew exactly what was going to happen and they knew exactly the effect that it would have on the markets. Now, I don't know if the reason that post came out was so whoever had the inside information could make money, or maybe Trump was just looking at the bond market going yippee, the stock market tanking, oil surging, and he used Truth Social post knowing that post would lift the markets, that's the reason.
This inside trading is happening while the broader economy accelerates toward a debt crisis. When the Secretary of the Treasury was recently asked how the government plans to fund the massive new war deficit, his response was unexpected.
Because so far the Iranians have denied that there's any talks or that they're making any progress. And again, I'm not going to necessarily believe what they say either, but I can't believe what anybody said. So the woman, and I forget her name, who was interviewing Scott Bessent, asked a very good question, which Scott Bessent not only didn't want to answer, but in very Trumpian fashion, he really made fun of the reporter for asking the question. Now, the question was very simple. Are you going to consider raising taxes to pay for this war? I mean, that's an honest, straightforward question. You want an extra $200 billion? Where are you going to get the money? And instead of answering it initially, he said, well, that's a ridiculous question. Well, what's ridiculous about it? What's ridiculous is that he doesn't want to answer it. He says, how ridiculous could you even ask me? Why would you even ask me how we're going to pay for this? It's like, yes, maybe it is ridiculous to ask the government how they're going to pay for something when they don't pay for anything. They just borrow the money. The Fed just prints the money. So according to the Secretary of the Treasury, this isn't just anybody. This is the Secretary of our Treasury. He's supposed to be protecting the Treasury. He gets asked, hey, how are you going to pay for this war? Don't ask me such a ridiculous question. Who cares? So then he said, well, why would we need any money? Well, what do you mean, why would you need any money? The country's $39 trillion in debt. You're the Secretary of the Treasury. Did you not notice all that debt? We have a massive budget deficit. What do you mean you don't need the money? He said, we got plenty of money. That's what he said. We don't need any money. We got plenty of money. No, we don't. If we had plenty of money, we wouldn't have massive deficits. Now, would we? Because we don't have plenty of money, we have to borrow all that money. That's the reason we have these massive deficits, is because we're out of money. We have to borrow the money. So we don't have plenty of money lying around to pay for this war. We don't have money lying around to pay for anything. So after first saying the question was ridiculous and then saying, well, we have plenty of money, they moved on. He never actually answered the question about how you're going to pay for it, but he eventually did rule out tax hikes because she pressed him on the question, and he eventually said, no, we're not even considering raising taxes to pay for this war. Well, then how are you going to pay for the war, Mr. Secretary of the Treasury? You're not even considering tax increases? I mean, we had a major tax increase to pay for World War II. It was called the victory tax. We didn't just borrow money. I mean, we borrowed a lot of money. The U.S. government sold war bonds to raise money for the war, but there were massive tax increases. In fact, up until the Second World War, hardly any Americans even paid the income tax. The income tax started, as I mentioned, in 1913 as a soak the rich tax, but the middle class didn't really pay it until the victory tax of 1942. And in fact, that's what introduced withholding. And look at what is happening to import-export prices. It's already happening in producer prices too. They're moving, again, that's a leading indicator of consumer prices. But import-export prices are a leading indicator of producer prices. Producer prices are already rising rapidly before March. In all the data that we have is from February and earlier. The war started March 1st. Oil prices are up 50% since March 1st, this month. None of that is in any of the February data or the January data. That is screaming inflation. So import prices in February shot up by 1.3%. That's just 1 month, 1.3%. Export prices, stuff that we produce and we sell abroad, those prices jump by 1.5% in 1 month. We're almost at the Fed's 2% target in a single month, right? Because 2 months of that would be 3% for export prices and 2.6% for import prices. Now, if you annualize these prices, right? Because when the government gives us the GDP numbers, Q4 GDP was 0.7. That's annualized. The actual increase was 1/4 of that. So whenever the government reports a number that's supposed to be high, like GDP growth, they annualize it. When they say GDP grew by 0.7% in Q4, they mean if you take the rate that the economy grew in Q4 and you multiply it by 4 to annualize it, then it was 0.7. Because just in the quarter, it was not even 0.2. It was less than 0.2 for the quarter. But inflation, they never annualize it. Well, if you take these price increases and multiply them by 12, because 1.3% increase in 1 month, you annualize it, you get 16.8%. 1.5%, which is the export number, annualize that, you get 19.6%. Imagine if the government says export prices up 19.6%, import prices up 16.8%. These are huge numbers. right? They don't seem as huge when you only report the monthly increase and don't annualize it.